It does take us to our talk of the tape. There was no sell in May and go away as the major averages pace for their sixth positive month in 7. Big question now, what now? Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, here with me, as you see, at Post 9. Welcome back. It's nice to see you on this Friday, last trading day of the month. That is the big question. What now? April was bad. We roared back in May. What do we do from here?
I think we have to appreciate just how much deterioration there has been under the surface and a lot of churn. The market's been a bit like a duck, calm on the surface, but a lot of commotion underneath. And what that's resulted in is deterioration in breadth. Only about 40% of names are above their 50-day moving average. We've seen a waning of momentum, so the market's kind of losing some steam. We think that translates to a bit more volatility. It's not the end of the world. It's not to say the rally is over, but to say that we have some more churn to happen. That volatility is likely buyable as long as growth estimates hold in, but that's what we will be watching for in June. Is
the narrowness that you point to unhealthy, or is it just fine?
It is disconcerting to see the amount of deterioration we did in some of the broadening out trade. It evaporated in a second over the last 2 weeks. You saw industrials completely reverse all of their relative performance over the last year or the last year to date in just 2 weeks. So some of that is concerning to see the deterioration in trend, which again just suggests that there likely is some more volatility to go.
What gets the trend going again? Is it because of a growth scare? Is it in part because rates had backed up? What is it?
Well, what got this trend kind of deteriorating is I think that there has been more question about rates and the Fed, and this question of if we could have a Fed hike back on the table. We don't think the data as it stands necessarily supports a Fed hike at this time. We think that PCE is just in this kind of middling territory where it's not cool enough to say that they can cut, but it's not hot enough to say that they can hike, which means that we did see a little bit of a lift in the market today on that data, maybe taking those hikes off the table.
Well, let me ask you this. Why don't we see more of a lift in the market today on the data?
I think we move very far, very fast. Tech is what's dragging this market down. And if you look at tech valuations, they're trading back to 2021 highs. It raises the question, is 28.9 times or around 29 times the ceiling for tech? Yes, the earnings are great. You're seeing earnings revisions move higher for tech. However, positioning is very stretched. And you had Jeff DeGraff on the program yesterday, and he talked about option positioning within semiconductors being extraordinarily stretched. So if tech doesn't work, that's why this market has trouble.
But tech is what's lifted this market up from the bottom, right? Tech is up 8%. The sector's up 8% in the month of May. The Nasdaq's up 5%. So you're talking about much more recently where some of these trades have started to unwind, really in the software space. Like if we showed you this week, and you guys can throw them up if you want, Salesforce, ServiceNow, Oracle, you can throw up some others too that pretty much tell a software roll.
And we have seen software rolling over really for the last 2 months. It's been under the surface where we saw Microsoft spend a lot of time below its 50-day moving average. And so we think that software has been deteriorating for some time, and it's not cheap. It's trading at about 30 times. That's up from 22 times just a few months ago. So what you have is, again, crowded positioning and a lot of high expectations that are then being met with these high valuations.